All right, man. Zoom is getting better. It's getting faster. Welcome to everybody who has tuned in today for Hedged with a capital D. The title is Mark Yusko from Chapel Hill. I'm joined by my partner Corey Lester up in the outside of the Windy City, and although I guess it's the snowy city lately. We are going to do something different this time. Normally, he and I have a guest on and we talk about some, big idea or set of opportunities. I thought we'd kind of go back to go forward and, never really done a meet the manager, so to speak, interview with Corey. So, yeah, I think most of you know him, but we'll do a little bit of the origin story, talk a little bit about how we set up the hedged portfolio and the idea of the opportunity fund and kind of where we are today. And then we'll talk about the title, Markets in Motion, themes as we get ready, believe it or not, it's hard to believe, heading from 2025 to 2026. And then we'll do, some fun at the end. So, all right, Corey, my first question is the same all the time. Where did you grow up and what was your thing growing up?
Oh man, well, it's good to be with everybody today, and not used to being on this side of the mic in the hot seat. So we'll try to do my best. So going way back, I was born in Pittsburgh, PA, but moved to a small town in West Virginia, Bluefield, West Virginia, when I was 3 years old. So for all intents and purposes, grew up in West Virginia. And my thing growing up was sports, and really soccer. I think my mom said at an early age, and still kind of reminds me of it to this day, that I wanted to be Pele. I think in kindergarten. So big soccer player. That was kind of my thing growing up.
Nah, look, I shared that passion, and you went further than I thought about playing in college, but got injured right before Notre Dame team got picked and started, and so I ended up just doing club soccer for the next 8 years in undergrad and grad school and men's league. But you went and played down here in North Carolina. Talk a little bit about that process and the experience at Davidson, which kind of set you on your formative journey.
Yeah. So I mean, soccer really, kind of got me into Davidson, and I played 2 years at Davidson before I kind of fizzled out. I found other things to kind of explore during my college experience. One being studying abroad. Studying abroad at Davidson is a big pursuit, and I think upwards of 40-50% of the student body travels and studies abroad. So I studied abroad for 6 months in Argentina. And then when I came back from that, just, really never got back into the swing of things with the soccer team, but, got into Davidson, with soccer, still have, maintained some of my best friends from those 2 years, and, still think very fondly of the game, and, think it's very apropos for kind of what we do, in that it's really the global sport, and we very much, manage a global portfolio. So still find myself talking about soccer during travels with managers, as that's really the common denominator, sports side of the equation versus American football or
Yeah,
basketball.
no, look, I think you could probably write a series of investment letters and even turn them into a book using soccer as the analogy for investing. I did something similar. My other big passion aside from soccer was fly fishing, has been fly fishing, is fly fishing. Heading to do some more fly fishing over Christmas break. Although I've still never been to Argentina, I need to do that. But I wrote a bunch of letters about fly fishing and investing, and I should probably pull those letters out and have ChatGPT turn them into a book for me. But um, most people know, but I don't know that everybody knows that you were one of the earliest creekers, as we like to call it, keeping on the water theme. Um, so how'd that happen? How do we come together, so to speak?
Yeah, I mean, to make a long story short, when I graduated from Davidson, through some connections at Davidson, I had the opportunity to work with a hedge fund in New York called Sands Point Partners. And that was run by a guy by the name of John Nicholson, and his trader, actually one of my mentors and still very close friends in the business, Stuart Feldman, kind of took me under his wing, and I worked very closely with him for 4 or 5 months right out of school. At the time, Morgan Creek was actually talking to Sands Point, and Morgan Creek was just ramping up, and I kind of really realized early on that specializing in a mostly kind of biotech, pharma, healthcare long short, hedge fund as my first job out of school was, a little bit too specialized. So kind of jumped at the opportunity to, really with the facilitation of Stewart, have a conversation with Morgan Creek. And Morgan Creek was looking to, hire its first analyst class at the time. And by class, I think memory serves, that was two analysts at the end of the day,
Yep.
myself and
Yep.
one other person. So, right time, right place, and really owe a lot of that to Stuart Feldman, who made the introduction.
No, it's great. And, again, many know the story, but, not maybe everybody. And I'll do the short version, although everyone knows I don't do short well, but I'll do the short version. So, I came down to North Carolina to manage the endowment. And I did that for 7 years. And, our position in Tiger Management was the largest position when I arrived, and we diversified it a little bit, and then Julian shut down. It's really interesting today, excerpts of Julian's letter from March 20th, 2000, where he basically said, I don't understand markets anymore. I'm sending all the money back. And I attached it to the letter from Michael Burry, who sent out the same letter yesterday saying, I don't understand markets anymore, and I'm sending all the money back. So more to talk about on that. But Julian became a mentor, and even call him friend. And when I decided to leave to form Morgan Creek, I got an email and said, "Say it ain't so, Julian." I joke I don't get a lot of emails from billionaires. That was actually my first one ever. Um, and I, trotted up to New York to see him, and he met me in the hallway of 101 Park and said, "Mark, I'm surprised you lasted this long. I like you, and I want to work together." I'm like, "Done. I will hit that bid." He gave us the seed capital to start Morgan Creek, and he also gave us the first $50 million to start what it was the time, one of the early hedge fund of funds called Tiger Select. And the idea was, we had backed everyone that spun out of Julian's shop over the years, from the original one, Lee Ainsley, to all the ones after that. And turned out they were pretty good managers, and there was a lot of talent. And so we did that. And so we needed some horsepower to analyze these funds and to expand beyond just Tiger. So we had the capacity to do other hedge funds. So why we were talking to Corey's fund, and bring Corey in just with and one of the big things that I think separates Julian as a identifier of talent is he had this thing about he wanted to hire people who were competitive. Like, he didn't care what, right? Golf, tennis, tiddlywink, soccer didn't really matter. And so one of the things that immediately struck me with CL was his competitiveness and his drive to constantly improve, and I thought it would make our process better. And so to condense it all down, we've been together a long time and worked together and grown this business together, but maybe talk about, and now it's amazing to think, Corey, it's almost 13 years ago when we had this idea to create the hybrid structure and what that means.
Yeah, so kind of fast forwarding to that time period, when I joined Morgan Creek, I was in the Chapel office for about 6 months. And then at the same time, Mark and the other partners were opening up the New York office, and the senior, person in that office at the time, another big mentor of mine, giving him a shout out, David Kim, needed some help. And I kind of raised my hand to go up to New York and help David. And that office, grew over time. And, it was really kind of during my formative, time in the industry. And that office was special because it was within, 101 Park. So, we were invested in some of the managers, not all of the managers, but really at a very young, point in my career, got exposure to some of the titans of the now business.
Again, not to, it's not a brag because we were just lucky and very grateful, but I hope people really understand and appreciate. I mean, when we say 101 Park, it's jargon to us, but that's the office that, Julian has the penthouse floor, 48th floor, as well as the 47th floor. And then he, had a couple other floors as they grew. And, at the beginning, it was just Tiger Management, Tiger Fund. And then when he shut down the Tiger Fund, he kept the family office, but also kept this new business he had started, which was, the Tiger Seeds. We actually coined that term for him in our fund because we were investing in all of these seeds because there was the Tiger Cubs. There were people that left Tiger that worked for him and he helped, get them founded. But then there were these other class of managers who may not have actually worked at Tiger, but they, were very good at what they did. And he seeded them. It was one of the very first seeding businesses. And so we were in essence, a form of a Tiger seed. We were the only fund of funds that he lent his name to, the only one that he allowed, to have that premium real estate. And, for DK and CL to be in the midst with some of, the living legends of today, Chase Coleman and many, many others. I think it was special. It was fortuitous. It was lucky, but man, it was super special.
Yeah, and we can maybe circle back to this later. But one of my, most salient kind of memories from that time, twice a month, the fund managers would gather around a table on the 48th floor, usually around lunch. We got to attend. I got to attend. I didn't get to participate. I got to listen. So I'd usually sit in the corner, just, feverishly, taking notes. But I just remember in 06, 07, everybody was just, constantly pitching, kind of long ideas. Everybody, I think, was supposed to pitch a long and a short idea. And I just remember Julian always saying, don't forget about the short side. Don't forget about the short side. And, it just kind of reminds me of the environment we've been in the last couple of months. Things are turning, obviously, as we speak. But that's one of my, really salient memories from that time. But back to the question about, hybridizing the fund. For the longest time, as an analyst, we were, monitoring these managers, and, monitoring is a very, rigorous and, tedious process. You're reading through all the letters, you're compiling all the data and the information, you're summarizing at the portfolio level. And we got really good at the monitoring process. And, we realized that we had all these insights and that these insights could be actionable. And so we kind of thought about it, kind of tinkered with it, did some back testing for a number of years, actually nicknamed the project, or Mark nicknamed the project, Project Quantum. And we just had the realization that with our relationships, we could probably get more out of our relationships with our managers than just the traditional LP. And by that, we meant that, we wanted to manage a direct portfolio alongside our LP interests and investments in these funds that really supersized their best ideas, whether it was a public long, being very sensitive to, any conflicts of interest, occasionally a best idea short, also being, very sensitive to any conflicts of interest. And, also, later stage privates where, liquidity of a high conviction private, also fit the constraints of the portfolio. So,
yeah, I mean, it's such an important point that we didn't come up with the idea. It's not really that novel an idea to say, hey, if you're invested with really talented people, you should, listen more intently and act with more conviction on their strongest conviction ideas. And in essence, it was just copying, which, much of Morgan Creek is copied from Tiger. I mean, we set up the Morgan Creek Foundation and give a piece of our profits every year to that, just like the Tiger Foundation. I mean, that was a direct copy. We tried to aspire to hire, quality talent the same way Julian did. We didn't have quite as rigorous a test on the way in as they did. And so I just had a lot of admiration for his process. But what I loved about these, Tuesday meetings was, again, he's asking masters of the universe, guys who really don't have to do any of this because they have billions of dollars under management and big teams themselves. But he's basically mandating that, you come in and you get a couple minutes to pitch your two or three best ideas. And you say, well, why does that matter? Well, if you actually look at the data, the top two or three ideas generate the bulk of the returns in most people's portfolio. We've all seen the stat lately that, the top 3% of S&P 500 created all the wealth. And it's the same for portfolios, but the average person, the average portfolio manager is never going to run a three stock portfolio, right? Because the volatility would be too high. And they want to keep the assets. They don't want people to leave. So they diversify, and hopefully they don't diversify. They keep the balance between concentration and diversification, tight enough that they outperform, or they have the power law where they double up. And again, another thing about Julian, so what was special about that was it was his idea, this best ideas portfolio. But you have to have both knowledge of and access to the talent. So we had knowledge of, we knew who the most talented managers were, and we were invested with many of them through Tiger Select, but you had to have access to them because so many people say, oh, well, I can just get the data from the 13F. Well, I mean, you can, but it's stale, meaning it's 45 days old. And in many cases, the largest positions don't necessarily mean it's their best, highest conviction idea. It may have been something that's already worked out and they're selling it to you when you're buying it from the 13F. In fact, there was an ETF that tried to do that with the 13Fs and it didn't perform very well. But again, make a long story short, we took this idea, and because of proximity and because of the talent that, Corey and David, and then David went on to work with a hedge fund. And Andrew, it was another one of our analysts, and others on the team, because they had a discipline. And this is I think the real differentiating factor, and it goes to competitiveness and playing soccer and all these things. The discipline that Corey and the team put into developing this best ideas worksheet, that it was a living document. And I'll give you the proof statement, right? So, I pitched this idea. We collect, it's like Maverick and Goose. We have pitched this idea to lots of people. And just about universally, actually, I don't think anyone's ever told me it's a dumb idea, but almost universally, people are like, yeah, we were going to do that. I'm like, okay, but did you? And almost inevitably they say, well, no, I never got around to it. But more importantly, a couple said they call bullshit. They're like, I don't believe these guys will share their best ideas. So this is one of my favorite stories. So one, prospect literally called one of the managers at 101 Park and said, Morgan Creek is out there claiming that they talk to you every month. There's no way. And the PM said, well, yeah, actually, we do talk to them every month. And, come to think of it, they're the only client we talk to once a month. And the guy said, well, why would you do that? He says, well, because we get more from them than they get from us. He says, what are you talking about? They're not a hedge fund manager. What do they know? He said, well, I'll give you the example. So, we, as Corey mentioned, it's a global business, like football is a global sport. And we backed a manager that spun out of Lone Pine over in Hong Kong. And we would get on the plane and fly the 15 hours to Hong Kong and go physically meet with them. And Corey was over there when they coined the term Amazon roadkill, which was long Amazon, short all the retailers. And this manager in New York was more focused on energy and industrials. And they were talking over coffee about an energy idea. And the guy asked Corey, what do you think is another good idea? He said, well, I was just over in Hong Kong, and this guy talked about this thing, Amazon Roadkill, and went through the list of shorts. And one of the shorts happened to be Under Armour. And this very meaningful manager put a meaningful amount of money. Like we never put big, huge positions because we're not big and huge. But these guys were big and they put a lot of money into it, Under Armour. I think it was $80 and it went to like 4. So they made a lot of money. So I said, look, we're going to talk to Morgan Creek a lot because we made a lot of money. And somebody said, oh, you just got lucky. That was one time. But we have dozens and dozens and dozens of examples like this where we built the relationships. And again, it's the team focus. It's, if you're a striker on the soccer field, it doesn't matter how good you are if the midfielder won't pass you the ball. In fact, one quick side story that I think is funny goes to soccer. So, I live in Chapel Hill, and Anson Dorrance, legendary coach of the women's soccer team here at UNC, and he recruited, the best player in the country and brought her in. And first game, UNC was losing 3-0 at halftime. They were never behind 3 goals, like ever. In the 27 years I've been here, I'm not sure they were ever behind 3 goals. And he says to the girls, he says, the such as I don't remember her name, she says, it's wide open. Well, why won't you give her the ball? And these 2 captains said, we hate her. We don't care how good she is. We're not giving her the ball. And he said, you'd rather lose than give her the ball? And they're like, yeah. So they had to change the team dynamic. And so teams matter. And I think we built a pretty solid team of relationships through Corey's shoe leather and hard work and diligence. And anyway, that's a long-winded way of saying it took time to build what we have, but the results are there. And one of the things is long short, so hedged with a capital D. The goal of long short is to generate equivalent returns to long only over the long term, not every quarter or every year, but over the long term, with half the volatility, right? That's the whole premise. And why does that matter? Well, if you can compound at the same rate with half the volatility over a couple decades, you'll end up with twice as much wealth. And it's just the way math works, right? If you're down 10, you got to be up 11, down 20, you got to be up 25, down 50, you got to be up 100. So, Roy Neuberger had it right? 3 rules to managing money. Rule number 1, don't lose money. Rule number 2, don't lose money. Rule number 3, don't forget the first 2 rules. Now, it's impossible to never lose money, but if you can mitigate the downside, which is what the hedged model, the A.W. Jones model does. And we've written a lot about A.W. Jones. We've talked a lot about A.W. Jones. Julian was a disciple of A.W. Jones. I mean, the guy who put him in business or encouraged him to go into business. The guy that put him in business was his partner, Sam, who had the money. But A.W. Jones' nephew was his partner at Kidder, who encouraged him to start the first, long, short fund aside from A.W. Jones himself. So all of that goes to this. We believe that the strategy is a superior way to manage equity risk. And the process of building this hybrid model, we think is really the way to do it. So from that, if we assume that maybe we're correct, that this is a good way to manage capital, maybe talk, Corey, about, like say themes, because we've always been thematic investors. We always have these 5 big long-term themes, and then we try to have, 5 expressions of those themes that are kind of midterm, and then 5 short-term. So we said we always have kind of 125 kind of good ideas to pick from at any one time. So maybe talk about how those themes shape the portfolio.
Yeah, I mean, I'd say, right now I'm really spending my time in kind of four big themes. And I'll let you drive in terms of what you want to talk about in which order. But, they're, China, and within China, spending a lot of time within the China solar industry, healthcare, and within healthcare, biotech and pharma. On the short side, have a theme called kind of rifle shot shorts. Think that the shorting environment just got a lot better in the last 2 weeks. Would see a lot of opportunity still there going forward as some of the craziness gets flushed out of the market. And then lastly, technology, and then within technology, you've been spending a lot of time within AI like everyone else. So those are
Yeah.
the kind
So,
of
I
four
mean,
big themes right now where I'm spending the bulk of my time.
yeah. Maybe we'll do it in, reverse order in the sense of the one that no one wants to talk about, which is China. Uh, and we've been investing in China for a very long time. I mean, I've personally been investing in China since, 1993. We've been through many cycles. We've had a team on the ground in China since 2007. We've invested in the public markets, the private markets, made lots of money in tech, made lots of money in healthcare. But this is a really unique take. We've shifted. We still have exposure to tech and some other things in China, but this idea in China is a little different. So talk about that.
Yeah, and I just say that it might surprise some listeners to know that MSCI China is up nearly 40% year to date. So China's decidedly back in a bull market. But if you look at valuations overall at the index level, they're still well below their 10-year average. And interestingly, if you look at the dividend yield in China, it's 4%, which is well above 1-year rates at about 1%. So, we think increasingly there'll be, flows into equity markets and away from things like real estate domestically. And this good performance, up almost 40% year to date is likely starting to attract, foreign capital flows back into the country.
Yeah, I mean, if you would have asked anyone at the beginning of this year, what's the probability that China could be, double the Nasdaq and almost triple the S&P in 2025, they probably would have, taken capital from us immediately. But here we are. So I think that's interesting on its surface. But the other idea within China, I think, is even more compelling just on a pure multiple of invested capital potential. Not promissory, but potential.
Yeah, yeah. So peeling back the onion a little bit more, I mean, there's an old saying in this business that you make the most money in emerging markets when things go from truly awful to merely bad. And,
Yep.
across a lot of industries in China, that's kind of happening as we speak. And, I've also learned over the years that, kind of a repeatable, and it's really hard to find repeatable, investment, themes and kind of disciplines in China, but one that, is fairly consistent is investing in supply side reform. If you look back to met coal in 2015, there's a big opportunity there. Aluminum and polysilicon more recently, and now the government really has its sights set on the solar industry in terms of its ongoing anti-involution campaigns, and really just clamping down on destructive competition over capacity. And it's well underway. The stocks, been in a bear market for many years now. Many of the large cap, really leading solar companies, listed in China, down anywhere from 80 to 90% from their prior highs. And if you look at a couple of years, these really, global leading companies are likely going to be the consolidators, within the industry as some capacity is taken out by the government. If you look at a couple of years on, a normalized earnings basis, with very, very conservative multiples, you can see these stocks getting back to prior highs and more. So, just look up, without naming names, some of the largest cap, Chinese solar companies out there, and you can see what we're talking about. And it really looks like, this is starting to turn the corner. Looking at things like bankruptcies and liquidations within the space, the capacity withdrawal appears to be well underway. So something we're super excited about. I think it could be a huge alpha generator for our portfolio, for anybody's portfolio, really, over the next couple of years, because I guarantee there's not too many people out there that have Chinese solar as an overweight position in their funds, nor
Yeah.
their
No, no.
SIPs.
One of the things about, again, the process, right? And the discipline. So our discipline has always been to, sift through managers to pick, 10 to 15 and, pretty low ratio, almost like getting into Y Combinator these days. Um, or I guess the Chicago Marathon, like which has a higher or lower acceptance rate than Harvard and Yale, which is kind of crazy. I don't know why anyone would want to. No, I'm just kidding around. I mean, lots of people love marathoning, not me. So
was about to say I wouldn't know.
yeah, I know.
My
Not me.
marathon days are behind me.
Yeah. So I think it's interesting in that, we look for certain things and one of them is discipline. And the manager that is implementing this idea for us, I don't know that I've ever met, it's a big statement because I've met a lot of managers. I don't think I've ever met a manager with as great a discipline as these guys. They only raise a fund every 4 or 5 years. They wait for the fat pitch, right? They are literally the epitome of, they're no called third strikes, and they wait and wait and wait until bankruptcy hits a certain sector where everyone hates the sector, right? That's the key. And then they buy one sector, concentrated portfolio, and they wait. But their level of discipline, um, they have a level of discipline that could produce a Pele. Um, so maybe they are the Pele of concentrated investing. All right. So what's up next? What do you want to talk about next?
I mean, maybe sticking with some kind of out of consensus ideas, healthcare
Yeah.
within that, biotech and pharma, even though it's starting to become, more, not consensus, but definitely more in favor, after a rough start to the year. I mean, XBI, just looking at the, ETF proxy in the space was, down over 20% back at the April lows. It's now up in the mid 20s, and healthcare has actually been, fairly defensive here the last couple of weeks amidst the sell-off elsewhere. So, a couple of years ago, we thought this was a value opportunity, not a value trap. Biotech had been in a 5-year bear market. Like I said, it was a rough start to the year, but investors, worst fears about tariffs and regulations have not really materialized. And, investors still, looking at prime brokerage data appear to be very underexposed. And, bigger picture, healthcare, remains a very vital part of the economy, delivering care and innovations to meet societal needs that are on the rise due to an aging population. It's still a joke from Mark. I tried really, really hard not to turn, turned 40 a couple years ago, but here I am now at 42. So, the population just keeps getting older and older. And, even though, biotech and pharma has really been in this bear market the past, 4 or 5 years, just now, turning the corner, innovation never really stopped. We've talked about, in these forums, Insmed a couple of times. They've just had some really killer developments within the, asthma and bronchiectasis market. That stock has, defied the bear market of the last couple of years in biotech, and has really been an outsized winner. There's other success stories like that, and your capital starting to gravitate back into the space. If you look at M&A levels, there are a couple of deals just now announced in the last couple of days, but they're already 2x all of last year. So we think the bid is in for biotech and pharma and healthcare overall now. I think even more so, just given the defensive turn in markets as of late. And even though the XBI is up 20% year to date and well off the lows in April, there's still a long ways to go looking at the charts to get back to prior highs. So lots of good stock picking opportunities within.
Yeah. And I think the nice thing about healthcare is there is an element of creative destruction in that, new innovation creates great long opportunities, but it also can create interesting short opportunities. And yeah, look, short selling has been maligned in recent years. It's been, it was nearly impossible to do when interest rates were zero because the short interest rebate disappeared. It has been very difficult in a QE world where all the passive flows have inflated everything. But suddenly, and this is usually the way it happens, um, the tide's going out, and again, quote Buffett, we are seeing who's swimming naked, and healthcare is full of those opportunities. United Healthcare is a great example, although it got so cheap, maybe it's flipped to a long now. But all right, so before we get to AI, let's talk about the third theme, and then we'll finish on AI, and then we'll do lightning.
Yeah, no, that's a good segue into the third theme, kind of being rifle shot shorts. And I think at a high level, we do believe that the short side, separates the truly great from the merely good in this industry. Um, and just looking at the market kind of dynamics overall, it's been a pain trade for short sellers until the last couple of weeks. Looking at the stock rally, post the Liberation Day sell-off. Very curiously, that the highest multiple stocks were performing the best. Things kind of got really crazy, and the market has, in a lot of respects, kind of turned into a casino. If you look at the number of levered ETFs, the new launches were just off the charts. There were dozens and dozens of these things being launched on a daily basis. By last count, well over 700 levered ETFs, many of which, are leveraged on single names, both to the upside and downside. And, this was a very difficult environment for short selling. If you look at the Goldman Sachs and Morgan Stanley most shorted indexes, now they're both down, double digits month to date. But before this month, they're up well over 40%. So well in excess of, the U.S. indexes, looking at the S&P and NASDAQ. If you look at the meme ETF, it's now down 20% month to date. So even more downside there. So the environment has, really turned abruptly here. But look, this mania, could, in hindsight, be even bigger than the dot-com era mania, just given how easy it is to coordinate nowadays on various platforms in social media. So, even though a lot of these, high flying stocks are, off, 20, 30, 40%, in short order, many of these, are still up triple digits, looking at year to date and trailing 1 year performance. So, we actually have an internal basket of bubble stocks that, we've been tracking, and, they're all down 20%, plus month to date, some as much as, 40% over the last couple of weeks. But we think that, there's still, a lot of opportunity here. And, kind of circling back to Mark's comments about, Julian kind of sending out his letter at the market, top, Michael Burry maybe doing the same with, deregistering his hedge fund today. If you look at the late 90s and the early 2000s, this, arguably was the heyday for a lot of, long short managers, as you had this separation when things broke between quality and junk. And the hedge fund managers, by and large, were long quality and short the junk. So, we can actually segue into this next after Mark chimes in here. But, I kind of think that, there's another theme emerging here, along the lines of Amazon roadkill, which was one of the big dominant things coming out of the dot-com era bubble in the early 2000s that lasted a decade plus, and in some respects is still persistent today. But one theme that I think could be even larger, an opportunity for great long short managers, is AI roadkill. So I think there's a lot of bubble talk in AI right now. But I think the bubble is more in some of the high flying stocks that are now down 30, 40% in short order. Some of the quantum computing stocks, for example, but many, many more. And the separation of the quality, I think there is quality within large cap tech, within AI, and everything else, over the next couple of years, is a great setup for some huge alpha generation amongst, many of the managers we like the most.
Yeah, I want to just put some numbers around something you mentioned, Corey, um, on the short side. I mean, in terms of how crazy the world has gotten in the past few months. So, you know, it's bad enough to trade companies that basically have no revenues, let alone earnings, to multi-billion dollar multiples. But that has happened, and we've seen lots of examples. And look, in biotech or something where it's a binary outcome, yeah, fine. You know, you're betting on whether the FDA approves the drug or not. Okay, that's pretty standard. But in something like computing or software or hardware, it really doesn't make much sense. And quantum computing was one of these areas that just suddenly everybody started to buy, just even though they didn't really understand it. And all the big guys said, "Oh, we have a chip that can do that too." And it's like, well, but it can't do math. Yes, it can factor prime numbers, but it can't do 2 + 2 = 4 with 100% accuracy. So I'm not sure that's very useful. Long story short, um, these companies became super pump and dumps. So what do I mean by that? Meaning, if you look at the insider trading, they were selling, selling, selling. In fact, today there's one called D-Wave. The CEO finally sold the last of his shares. So he now owns 0 shares while everyone else has been buying this company, again, that has no revenues, 0 revenues, and a multi-billion dollar market cap. But there's another company called Rigetti that actually had a small contract, like a $6 million government research grant, but it got to a multi-billion dollar market cap, and they created a 2 times levered ETF. So you own one stock, Rigetti, 2 times levered, and from early September to about a month ago, it went up 25 times. It went to a $500 billion market cap. And, today is down 84% and falling fast. But that's how crazy this part of the market got. So I think it is a target-rich environment, and one where, being selective with rifle shots, not a scatter shot. You can't do a valuation short. We learned that the hard way with Tesla years ago. But I think there's big opportunity. All right, so let's jump to the good stuff of AI and talk about that.
Yeah, so I'm a believer, and I do think that this is a generational investing opportunity and kind of generational shift in the technology platform. We went from the server and the PC to the internet and mobile to now AI, and I think the consumption device is still kind of TBD, but you have on the consumer side at least Meta focusing on glasses. You have OpenAI teasing a product as well. So I think there will be some kind of new form factor that is yet to be decided that we all wear, have, and own at some point, like an iPhone in the near future. And I kind of think it's not a bubble because everybody else thinks it's a bubble, and the consensus is usually wrong. And as I mentioned before, I think the bubble is really right now in that speculative, manic corner of the stock market that Mark was just talking about. I mean, the quantum computing stocks are one example, but there's many, many others where, fundamentals and valuations are just completely disconnected. Yep. And, it's more of a casino right now than the market. So, yep. If you look at AI overall, everybody talks about CapEx, and, I think the CapEx, is going to be there, the next couple of years because it's coming from well-funded, balance sheets for the most part. And, we were talking about GPU clusters of only, a couple thousand a few years ago. Now they're measured in the hundreds of thousands, soon going to the millions. And, the 4 kind of things I'm focused on are kind of users. Do the number of people using this technology, is it continuing to grow? I was just going to say, and maybe we can segue after this, but I think in terms of just like, monitoring whether this is a bubble or not, there's 4 things like I would watch closely. One is the number of users, and you can see that just looking at the LLM user data from the likes of OpenAI, Anthropic, tokens, the amount of compute that's being used, and that continues to grow. Looking at statements from Google recently where And they said, last month they processed, 1.3 quadrillion. We're now measuring things in quadrillions of tokens, which was up 20x year over year. And then, the third being revenues, and revenues are increasing. There's a couple AI applications within coding. One this morning that just raised a bunch of money, where revenue, is now on an annualized basis at $1 billion. So just watching for anecdotes there, and then just GPU usage. So I think a false potential analogy in the market right now is to the dot-com area, where there's a lot of dark fiber laid in the ground that was never used, or it took a lot longer to use than initially anticipated. But if you look at all the GPUs that are in existence, they're all being used at maximum utilization. So as long as that's the case, then I don't think it's a bubble. And those are kind of the four things I'd watch very closely, going forward in terms of, watching for any, hiccups in the growth outlook for the theme and technology. But, can talk a lot more about it. There's huge opportunities within. We're playing it on both the private and public side. But we'll let Mark take it.
No, I was just speaking. So since we have a little bit of time before we jump into the lightning round, which we'll do here in a second, I just wanted to give it's an interesting quote, and some people love Elon, some people don't, but he is a pretty smart guy, generally speaking. He has a quote, and this goes back to our first theme: solar electricity will become by far the biggest source of power for civilization. Okay, that's a big statement. China is the majority of electricity growth on Earth. 3/4 of the new supply is solar. Again, those are some big numbers. And part of this, and goes to the AI question, is, look, I have said, and we've talked about this many times, that a decade ago, maybe it was 15 years ago, it doesn't really matter. China figured out that the next dominant superpower was going to be secured by chips, not ships. That, the days of naval superiority to ensure global superiority were over. And it was now about cyber superiority or AI superiority. 96% of AI citations come from China. Electricity growth, staggering. They have 2.5 times more electricity production growth than we do. Building more nuclear in a year than we have existing. So that's just one little indication of how important this is. They're reshoring all of the chip making technology. So anything above 8 nanometers, they can make in China, not in Taiwan. That's a really big issue. And there's a lot of form factors at 12 and 16 nanometers that are going to dominate the things that we all use chips for every day. In fact, there's an interesting movement in a company called Cerebras, which is actually a competitor-ish to one of our favorite companies, Grok. But there's a wafer scale chip movement, and there are drawbacks, but the idea of having thousands and thousands of microchips linked together by cables and bathing in liquid coolants might be inferior to these larger scale chips. And Grok isn't at a small scale like some of the TSMC chips. So lots of things we could talk about, but without any hesitation, let's go to lightning. And Corey, what is the personality characteristic that you're looking for that identifies a great long short manager?
Oh, that's tough. I'd say creativity and competitiveness.
Okay, perfect. Love it. And again, both things are super important on the soccer field. So when did you, I guess we'll say, see the long short management light? Like, there are a lot of things you could have done with your career, a lot of directions you could have gone, but you've spent, the bulk of the last 20 years together. We have spent the bulk of the last 20 years together really obsessing about this long short hedge with a capital D. So was there a moment in time where it just became apparent to you that that was the right way to manage capital?
Yeah, I mean, I already talked about it earlier, but when I had the unbelievable opportunity to sit amongst many of the
Yeah.
greats for 3 years at 101 Park, from 2006 to 2009, I just kind of realized then that this is what I wanted to do, long term, and these are the people I wanted to surround myself with.
Yeah, awesome. Again, get on the right team. Always the best, most fun. So where do you look for inspiration for investment ideas?
Um, Reading. I mean, I remember speaking to a manager one time and kind of asking about his research process, and he just said he had an insatiable appetite for reading. So I pretty much read nonstop. My wife always makes fun of me because I never read fiction. I've tried to actually incorporate some fiction here and there, but just always reading and just reading different sources and manager letters. I mean, we have the fortunate position of receiving lots of letters, some because we're invested, some because we're prospective investors, some because we're just on distribution lists from hundreds and hundreds of managers. So just scouring those letters quarter in, quarter out is, where, a lot of my inspiration comes from in terms of, new idea generation.
I'm going to double down, double tap on the manager letters. I used to have my assistant literally print them off because I'm old school. And so I'd have this big, literally like 3-inch stack of manager letters. And so when we'd be down at the beach or someplace, I would just sit for hours and hours and read, because you're talking about some of the smartest people in the business who then spend tens and tens of hours distilling what they see and think, and then you get to absorb that, and it's an extraordinary asset, huge
Yeah,
asset.
and I'd say, Mark, you have a great saying in that respect too. You got to make sure you're listening to the right people. But if you hear it once, you write it down. Or if you hear
Yeah,
it once, you remember it. If you hear it twice, no, you hear it once, you write it down. No, hear it once, remember it. Hear it twice, write it down. Hear it 3 times, do something about it. That can lead to groupthink, but if you're listening to the right channels, it often leads to some amazing, ideas if those, same themes are coming from independent sources that you have validated and respect.
well, and the best thing is if it's literally the first, second, and 23rd time, that's a lot better than the 4,376th, seventh, and eighth time. So yeah,
Exactly.
if you listen early and take the really crazy ideas and remember them, then it's super valuable. All right. So to that point, so I think we said manager letters are what you read on a consistent basis. You couldn't live without. All right. What do you do for fun?
Um, I mean, I guess it depends on the season. I mean, I love getting outside. So, big skier. In the wintertime, it's skiing. It's being in the mountains. In the summertime, not so much soccer these days, but play a lot of golf. So summertime, the golf course, wintertime, the mountains.
All right. Best secret spot to eat on the North Shore of Chicago?
Ooh, that's a tough one. Where I live in Wilmette, it's kind of turned into a hot spot. And, we have a great little ramen restaurant in town called Torino. So next time you're in the North Shore and if it's cold and you need to warm up and are hankering for some ramen,
I
Torino
love it.
is
It's
a
a
good,
staple. Love it. All
good
right,
spot.
man. All right. Where do you escape when you need to get away and recharge the batteries?
Um, kind of already mentioned it. I mean, love the mountains. I mean, skiing is my passion. So if there's snow, you can always find snow somewhere,
Yeah.
whether it's northern hemisphere or southern hemisphere. But skiing, or if there's no snow, the lake. Love being around, Lake Michigan and all it offers in terms of being able to get outside.
No, 100%. It's interesting. I read something today that they say doctors in Switzerland tell you if you're feeling bad, you should go out in the sun. Doctors in Japan say if you're feeling bad, you should take a swim in the ocean. And no. It was doesn't matter where it was. It was someplace else. It was take a swim in the ocean. I think Norway, take a swim in the ocean. And if you're in Japan, it's take a walk in the forest. So it's always about getting back to nature. All right. If you could have dinner with anyone, living or in the past, who would it be?
Um, that's a good one. Um, right now, just because AI is so topical, I'd have to say Jensen Wong. Just love to
Yeah.
pick his brain.
Yeah. Love it. All right. Most impactful book you've ever read.
Impactful. I'd say on the investment side, I actually have a copy of it sitting here right beside me. Um, Margin of Safety, Seth Klarman, one of the first books I read when I got into this industry, just made sense, resonated. It's really good stuff. On the non-investment side, always loved Hemingway, would say The Sun Also Rises, just
Yeah.
the sense of adventure and exploring. Just love that book.
Beautiful. Beautiful. All right. Well, look, Corey, this was fun, and I can't believe it took us so long to do it, but appreciate everybody being here. We're grateful for your partnership and friendship, and look forward to many, many more years of best ideas. So, Corey, last word's yours.
Thank you, Mark, and thank you for the opportunity. And it's been a great 20 years working together, and I look forward to the next 20.
All right. Thanks, y'all.